Are you struggling to make sense of the market's ups and downs? How do you predict where the market is headed and the next big price move? Hey friends, today we've got an exciting topic lined up for you: supply and demand in Forex trading. It's one of the fundamental concepts that every trader should understand. So let's dive right in. Well, before that, it's question time, guys. What did the economist say when he tried Forex trading for the first time? I've finally found a way to put my supply and demand curves to work. Now, let's try to understand what supply is. Supply in Forex refers to the amount of a particular currency pair available for trading in the market. When supply increases, the price of the currency pair tends to decrease and vice versa. On the other hand, demand is the desire of traders to buy a particular currency pair. When demand increases, the price tends to rise, and when it decreases, the price falls. Effect of demand and supply on currency pair prices. Understanding the interplay between supply and demand is crucial. It determines the value of currency pairs. Before moving forward, answer a question. What did the Forex trader say when asked for dating advice? Find someone with whom you have a balanced supply and demand of love. That is good advice. To give you a clearer picture, let's look at a real-world example. Imagine the European Central Bank announces a decision to increase interest rates, making Euro-USD a highly sought-after currency pair for trading. This decision sets off a chain reaction, causing fluctuations in the prices of Euro currency pairs, driven by the dynamics of supply and demand in the Forex market. Initially, the market responded positively to the interest rate hike, leading to a surge in buyer interest, demand, for the Euro-USD pair. More traders flock in to buy, resulting in a higher demand and a relatively lower supply. As a consequence, the price of Euro-USD starts to rise. However, as time went on, some traders started to believe that the Euro-USD has become overvalued. This leads to a drop in buyer interest, and those looking to sell Euro-USD find themselves having to do so at a lower price. With reduced demand, sellers adjust their prices downward to attract more buyers. Essentially, the supply surpasses the demand, causing the price of Euro-USD to decrease. Well, I feel Forex traders are the true romantics. They know that in relationships and trading, it's all about finding the perfect balance between stop losses and take profits. Now let's understand supply and demand zones. Supply and demand zones are crucial areas on the Forex chart where price has a high probability of reversing. Understanding these zones can give you a significant edge in trading. Let's break it all down. A supply zone is an area where sellers outnumber buyers, causing the price to fall. Conversely, a demand zone is where buyers overpower sellers, leading to a price increase. Let's move on to the supply zone now. Supply zone is a specific period on Forex charts when the price of a currency pair takes a noticeable and sudden drop. Now, why does this happen? It's because there are plenty of sellers who really want to sell that currency pair. In fact, there were more sellers than there were buyers in the market at that time. In this supply zone, you'll see a lot of sell orders. This tells us that many traders are eager to sell that currency pair at the current price. It's a clear sign that traders expect the price to go down. So for us traders, spotting a supply zone is a clear indication of potential price drops. Let's discuss demand zones now. Demand zone is a specific period on Forex charts where the price of a currency pair suddenly shoots up. Why does this happen? Well, it's because a lot of buyers suddenly become really interested in that pair. Now, this is demand zone. You'll notice a bunch of buy orders. This tells us that there are many traders who want to buy that currency pair at a specific price. It's a strong indication that traders believe the price is going to go up. So for us traders, spotting a demand zone is like a big green light signaling the potential for prices to rise. It's a pretty important signal. Where are the supply and demand zones on the Forex charts? Locating supply and demand zones on a Forex chart is as challenging as finding a vegan option at a Texas barbecue joint. Well, that's not the case. Finding these zones on the charts might seem complex, but don't worry, we're gonna walk you through it. A supply zone is essentially a zone where selling activity tends to be higher. You'll often find it near the highest level where a currency pair has faced resistance. Think of it like a spot where sellers become more active. Now, these supply zones often show up right after the price of a pair has reached a recent high resistance level, higher than any of its previous ones. It's like the price hit a ceiling and is now showing signs of heading down. You'll notice this in the chart as bigger red candles with longer wicks. The sellers in this zone have a hunch that there's a bearish trend on the horizon. They believe that the current price is as high as they can sell the currency pair for, and they expect prices to drop after this level. Demand zone, on the other hand, is that zone on Forex charts where buying activity really picks up. It's like a zone where buyers become more active, and it's usually found near the lowest support price level. These demand zones tend to show up right after the price of a currency pair hits a recent low support level. And this new support level is lower than any of the previous ones. It's like the price hit a floor, and now it seems like it's on the way up. You'll see this on the chart as bigger green candles with longer wicks. Now, the buyers in this zone have a strong feeling that there's an upward trend coming. They believe that the current price is the absolute lowest they can buy the currency pair for, and they're expecting prices to go up after this level. Factors affecting supply and demand. Now, what influences supply and demand in the Forex market? Factors affecting supply and demand are like that one friend who always changes the plans at the last minute. You never know what's going to happen, but you're left wondering why you agreed to this in the first place. Relax. I will make it simple for you. Here are the factors that affect supply and demand. First, economic indicators. Economic indicators like GDP, employment rates, non-farm payrolls, consumer price index, jobless claims, federal fund rates, and inflation affect a country's currency value. If a country's economy is doing well, its currency is in demand. Second, interest rates. Higher interest rates attract foreign investors looking for the best returns. This increases demand for the currency. Third, political stability. A stable government and economy create confidence in a country's currency, boosting demand. So now let's try to understand how understanding demand and supply zones helps in trading. First, it helps in determining entry and exit points. Understanding supply and demand levels can help you pick the right entry and exit points for trades. Traders might look to buy a currency pair when it approaches a demand zone. The expectation is that the price will likely rise from there due to the increased buying interest. Conversely, traders may consider selling a currency pair when it nears a supply zone. The abundance of sellers in this zone suggests that the price may struggle to move higher. Second, it helps in risk management. Analyzing the supply and demand levels of an instrument enables traders to anticipate its price movements. This knowledge is invaluable in strategically placing stop-loss orders, effectively mitigating potential losses in trades. All right, we've covered the basics of supply and demand in Forex trading. Remember, it's all about understanding the forces that move those prices. Practice, observe, and you'll start making smarter trading decisions. If you liked this lesson, don't forget to hit the like button and subscribe to our channel. Thanks for joining.